Okay, hi everyone. So we'll begin our webinar today. We see that we have quite a few people today. Hi Vincent. Hi Ryan. My name is Janelle, and today I have with me Cloris, who will be bringing you through the later half of the webinar. So today we will be doing an introduction to forex as well as mt4. Okay, so let's begin. Okay, so before that, we'll just take a look at some points that I will be touching on. So I'll firstly bring you through an introduction to the history of forex, and we'll take a look at the market structure, and then I'll introduce to you some of the more prominent market participants, and finally we will go through some of the forex groups and pairs. Okay, so I'm sure most of us wouldn't really have a very good understanding as to how our whole financial system came about. So basically, back in 1944, right after the World War, the end of the Second World War, basically what happened was countries realized that not having a good financial system in place and having poor countries led to a lot of very detrimental issues, and people started to get really violent because they needed money to survive, right? So what happened was that 44 nations actually came together to create an international monetary system called the Bretton Woods system. So this time was also when your IMF, your World Bank, as well as your WTO was established. So right after the end of the war, US was actually the most powerful country in terms of monetary, in terms of military might. And in fact, they actually had about 3/4 of the world gold reserve. So it only made sense to the other countries to think that they would want to tie their currency to the US dollar. And therefore, later, their currencies were tied to the US dollar, which were convertible into gold at $35 per ounce. So what countries would do then was to kind of buy and sell the currencies and to stabilize it within 1% of the peg level to gold or to the dollar. Oh dear, so sorry. Wait 1 second. Okay, sorry about that. So basically what happened after that was that about 30 years down the road, they realized that it was not very sustainable because this peg system and fixed system does not really account for the change in demand and supply. So they thought it made a bit more sense if they allowed the US dollar to fluctuate against other currencies, and the other nations started to follow suit as well. And so this actually formed the basis of our current exchange market, where traders essentially just play on the fluctuations of exchange rates, right? So moving on, we just take a look at the forex market. So basically, it is really just a place where currencies are traded and exchanged. And basically, it is the world's largest financial market. And here we have some stats. We see that the values has been rapidly increasing over the past about 20 years, and with the highest in 2015 topping at over $5 trillion in a day. And if we want to break this down by geographical location, we can see that London actually accounts for the largest proportion of daily traded volume, standing at 37%. And later, you have your Tokyo, Singapore, and Hong Kong following suit behind. And in third place, we have New York. So just these three countries alone, right? New York, Tokyo, and London, they already account for close to 80% of the daily world traded volume. So that is why typically when we're trading, we tend to focus a lot more on the top 3 markets or the top 4 markets, including Europe as well. So moving on. So here we have like some characteristics of our forex market. So basically it is a global market and it has no physical location. It operates basically 24 hours a day, 5 days a week, Monday to Friday, and essentially still taking your Sundays off. So here we take a look at the operation cycle. So these are the 4 different markets. You're going to realize that, so this is 24-hour mark. And you're going to realize here that before Sydney closes, Tokyo opens. Before Tokyo closes, London opens. And before London opens, London closes, New York opens. So essentially trading is happening all 24 hours throughout the day. And here we start at 10 p.m. GMT. So this is GMT, which is also 6 a.m. if I'm not wrong. This is 8 hours difference, right? 6 a.m. SGT. And your New York, therefore, again, closes at 6 a.m. the next day. SGT. So something we would want to note, right, when looking at this chart is that you're going to realize that the overlap between London and New York is actually the largest, right? So what this essentially means is that there is very, very high trading volume during this period of time. So you can expect large volatility, a lot of changes in prices because so many people are actively buying and selling during this period of time. Okay, so let me just move on and look at our market structure. So in here, we're going to look at the participants and the tiers of participants. So firstly, we have our interbank market. So these, so right here, right, basically we have our big banks, and even though there are not many participants, but most of the money eventually move here. So our $5 trillion, they all end up here, right? So in our second tier, let me just draw a line. We can just call this tier 1. So in our second tier, we have our big brokers, companies like XM, and they have access to all of the, sorry, give me a second. So they have direct access to the interbank market to trade bulk amounts for the clients, which will appear in our third tier here. So these are our clients. You have the retail trader, perhaps even institutional traders here, right? So let's look at our market participants. So again, like I mentioned, we're going to have our big banks, and our commercial banks, financial institutions. And we have our companies. So companies like this, they probably use pension funds, so on and so forth, to invest in our FX markets. And finally, you have the Joes like us, or retail traders, basically. So now we will take a look at how these FX pairs are traded. So typically, we always trade in pairs. So you have 2 pairs here, right? So essentially, why is this so? It's because we always take one currency to buy another currency, and it works for selling as well. So when we are selling US dollar, you want another currency in exchange. So it can be like SGD, USD, so on and so forth. So typically we call the base currency the first currency, our base currency. And we call our second currency the quote currency. So typically when on your platform, you're going to realize that all of the pairs you see will look something like that. So here we'll take a look at it, and we'll take a look at an example. So we have our euro, dollar, and USD. So if we were to say that EUR/USD equals to 1.13, what this essentially means is that you need 1.13 US dollar to buy 1 euro dollar. So you'll see that here. Okay, so let's take a look if EUR/USD equals to 1.4, for example. So what does this mean? So what this means essentially is that now instead of using 1.13 USD, you need 1.4 USD to buy 1 euro dollar instead. So you are paying, oh sorry, this is a minus sign. You are now paying 0.27 USD more than before for 1 euro dollar. So essentially your euro dollar has become more expensive. So we can therefore conclude and say that the euro dollar has appreciated. Okay, pardon my handwriting. It's not very easy to write with this. Okay, but anyway, so let's move on into our second scenario. So this is our first scenario. Okay, so let's move on into our second scenario. So what if now I tell you that EUR USD has dropped to 1.1. So what does this mean? So let's break it down. So what this essentially means is that instead of using 1.13 US dollar to buy 1 euro dollar, you are using 1.1 US dollar to buy 1 euro dollar. So you are paying 0.03 less than before, right? So since the euro dollar has become cheaper in terms of US dollar, we can now say that it has, sorry, wait, I think I might have messed up. Cheaper. It has depreciated. Right? Okay. Any questions so far? Sorry if I confused you with this thing. Okay, let me just take a quick look in the chat first. Okay, no questions. All's good, all's good. Let me just move on. Okay, so now we'll take a look at the most traded pairs in the world. So they are called majors. So they are highly traded. They have the most activity, basically. And they account for 80% of all the daily traded volume in the forex market. So we'll take a look at the examples. So you have the euro dollar, yen, GBP, the Swiss franc, the Canadian dollar, Aussie dollar, as well as the Kiwi. So one thing that you're going to notice is, right, that all of these pairs are actually paired up with the US dollar, if you realized. Right? And over here, you can see that each of these pairs, they actually have their own nicknames, which you will probably be pretty familiar with, or if not, get familiar with in time to come. So these are the nicknames. So if you happen to see anything like that, you know what it's referring to. Okay. So we'll move on into our next category. We'll just take a look at some characteristics of the major traded pairs first. So they are very liquid. So essentially what this means is that it's very easy for you to convert a major currency into another major currency because they are traded so much. They are traded so much that it is always easy to find. It's always easy to find and match a buyer and a seller, right? And not volatile. And it is hard to manipulate because the trading activity is so high. You have so many players. It's so hard to be the one that is buying or selling the most. Am I right? So, and then therefore that leads to a tight spread as well. Okay. So now we'll take a look at some of the currency pairs that do not involve the US dollar. So in this case, no USD anymore. Okay, so we call them cross pairs. And I'll just bring through why is that so in a bit. So it can be a mix of the major pairs basically, but without US dollars. So you can just mix and match. You have pretty standard, is what we've seen previously. So why is it called a cross pair basically? Is because let's say if you want to trade EUR and EUR and yen, what you have to do is basically to convert EUR USD into EUR into USD yen. Okay, that's a bit confusing. Let me try to illustrate it properly. Okay, so what you have to do, right, is you have to take your euro dollar, convert it to US dollar, take the US dollar, convert it to yen. That's why we call it cross pairs, basically. Does it make sense? Okay, so let me move on. And again, we'll take a look at some features. So they are less liquid, but still pretty liquid because the trading activity is still pretty high. And they are a little bit more volatile because they are not as widely used. And they are easier to manipulate. And also they have a little bit wider spreads compared to our major pairs. All right. So now moving on into our exotics. So our exotics are basically currency pairs that are paired up at least with, so it could be a major currency that it is paired up with, and the currency of an emerging economy. So emerging economy. Okay, so we take a look at some of the examples we have. So we have the Turkish lira paired with a major currency, Turkish lira again, and the Mexican peso. And even the Singapore dollar is considered exotic. Okay? And the Hong Kong dollar as well. All right, so now we take a look at some of the characteristics. So you're going to realize that these exotics compared to the majors are very, very illiquid, simply because they are not as heavily traded. So it will be rather difficult for you to convert one currency to another, because because it will be harder for you to find and match buyers and sellers. So they are very, very volatile, way easier to manipulate, and they have huge spreads. Okay, so any questions up to this point? No questions? Okay. So with that, I pass the time on to Cloris to bring you to the next section.
All right, thank you, Janelle. Maybe before I can proceed on to my next part, I'll just share with you some fun knowledge about why our currency pairs are quoted in one way. So maybe some of you guys have noticed that whenever currency pairs are being quoted, if it comes together with a euro dollar, then euro dollar usually comes before it's the base currency. So why do we quote it this way? It has to do with something called the FX market pecking order. So recalling that we have our G8 currency pairs, right? So we have the USD, Australian dollar, the Kiwi, the euro dollar, the euro, we have pounds, yen, and then we have Canadian dollar, and then Swiss franc as well. So in the order of importance, euro dollar, pound, Australian dollar, Kiwi, USD, and then CAD, Swiss franc, and yen. So they are actually ranked according to their importance. So when bankers quote to each other, they try to quote the euro dollar as being the base currency. So let's say if you are quoting, if you're quoting, oops, sorry, okay, Ken. Okay, so let's say if I'm quoting euro dollar, so usually euro will come, like all the time, euro will come as the base currency. Or let's say if you want to quote euro dollar with CAD. In the order of importance, according to our pecking order, euro dollar will also be quoted as the base currency. Okay, so this is just some general knowledge. Okay, so right now we can proceed on to my next part. And for our next session, I will be walking you through what a pip is and what is a spread. We also talk about what the lot size is, how do we calculate profits and loss, and of course, the different types of orders. Okay. So let's begin by looking at what a pip is. Basically, a pip or point in price is actually the smallest change in price in any given exchange rate. So for other instruments like indices or stocks, the minimum price movement is called a tick. For currencies, it's usually the fourth decimal point of the price. So let's take a look at a simple example here. So let's say if the price of euro dollar is 1.1358 now, the next price movement that it will make would be 1.1359. Okay, and the difference is 0.0001, or in other words, we call it 1 pip for simplicity's sake. And then some platforms, trading platforms, may actually offer prices in 5 decimal places as opposed to only 4. So let's look at the same example here. If we consider the price to be 1.13575, then the next price it will get to could be 1.13590. And the difference is that it goes up by 0.00015, or in other words, 1.5 pips. So that depends on the trading platform that we use for conventions. Okay, we can take a look at some examples here. Some common examples here would include the US dollar pairs and other currency pairs. So for pairs that pair with US dollar, they are usually quoted in 4 or sometimes 5 decimal points. So for instance, we just look at the example on euro dollar. It's quoted in, let's say, if it's 1.1958. But it could be quoted as 1.19582. So the difference is that the second one has 1 more decimal points. Whereas all Japanese yen pairs, on the other hand, they are an exception because their exchange rates tend to be lower. So they will be quoted in either 2 or sometimes 3 decimal points. So for instance, if the yen were to be paired with euro, then it would be quoted as 110.45, or sometimes we have 1 more additional decimal point here, 110.454. All right, we can go on to look at what is the spread now. So maybe we have heard of the word spread on a daily basis. So maybe we can take a closer look at what they mean. Okay, we can talk about spread. Before we talk about what a spread is, it's more important for us to know what bid and ask prices are. To put it simply, bid is basically the price at which we sell the instruments. And the ask price is the price at which we can buy the instrument. And bid price will always be lower than the ask price. So what is the spread? The spread is basically the difference between the bid and ask price, and it represents the cost of our transactions. So in our first example here, the spread of euro dollar is actually 1 pip, right? Because we are taking the difference between the bid and ask price. And then for pound dollar, that would be the spread would be 2 pip. For gold, or for dollar yen, that would be 1 pip. And then for gold, that would be 0.4. For Bitcoin, that would be 55. And then for indices, 0.8 units. For stocks, that would be 0.2 units. Okay, so as you may have noticed, the spread actually varies from one instrument to another. Okay, so let's look at what a lot is. On the mt4 and mt5 trading platforms, our instruments are always traded in specific amounts called lots. So in forex, one standard lot is 10,000 units of the base currency, and one micro lot is 1,000 units. Let's look at euro dollar. So one standard lot is 100,000 euro, and one micro lot is 1,000 euros. For pound dollar, one standard lot is 100,000 pounds, and one micro lot is 1,000 pounds. For dollar yen, one standard lot again is 100,000 USD, and one micro lot is 1,000 USD. And for commodities, stocks, and other instruments, a lot will represent the number of units of that instrument. Let's say for gold, that would be one standard lot would represent 100 ounces, and one micro lot is 1 ounce. For some instruments, the standard lot and micro lot are the same. Let's say for Bitcoin, one lot is 1 coin. For indices, then one lot is 1 unit of the index. For stocks like Facebook, one lot is 10 shares. Okay, so let's move on. Okay, for this slide, we will talk about how do we calculate profits and losses in forex pairs. So for forex, the profit and losses is calculated by multiplying the amount traded with the pips gained or lost. So for instance, if you buy one standard lot of euro dollar at 1.1358, and then you sell it back when it reaches 1.1373, you will earn 0.0015, or in other words, that would be 15 pips. Okay, so to get our profit, we will multiply this number by the lot size in the quote currency. So that is just simple multiplication. So we times this by 100,000, that would give us a profit of $150. And this is our profits. All right, let's look at another scenario. So if the USD is the base currency, then our profit or loss will be floating. So if we buy one standard lot of dollar yen at 110.5 and sell it back when it reaches 110.9, then we will earn 40 pips. So by multiplying this number by the lot size, we will get our profits in the quote currency, and in this case, it's actually yen, so we get 40,000 yen. But now we need to convert our yen back to USD, so we just simply divide the profits by the closing rate of the trade, which is 110.9. So we divide it, and then we get $360.68, and that's the profits that we get. For commodities, the profits and loss is calculated by multiplying the amount traded with dollars gained or lost. So if we buy one standard lot of gold at 1,205 and then we sell it at 1,200, then we lose $5. So the profits or loss in this case is calculated by multiplying the dollars gained or lost by the amount traded. So as one lot equals to 100 ounces, like what we've mentioned before, then our loss would be equivalent to $5 times one lot, and it represents 100 ounces. We get $500 as the loss in this case. For shares, the profit and losses are calculated by multiplying the amount traded with the dollars gained or lost. So actually in 3 scenarios, it's pretty much similar. the difference is that the lot size are usually different for different instruments. So in this case, let's assume that we buy 15 lots of Facebook CFDs at the price of $177, and we sell them at $178.1. That means we gain a per share profit of $1.1, right? And the profit or loss in this case is calculated by multiplying the dollars gain or loss by the amount traded. As one lot equals to 10 shares, then our profit is equals to 1.1 times the 15 lots of CFDs that we purchase, and then we times 10 shares in each lot, and that gives us $165 of profits. Okay, so at this point, are there any questions? Let me just take a look. Okay, I guess all of you are fine. Okay, then I will continue moving on. So the next topic, the next scenario is about indices. Again, for indices, the profit and losses are calculated by multiplying the amount traded with the points gained or lost. So if we buy 100 lots of US 500 index at the price of 2,644, and we sell them at 2,660, we gain 16 points, right? So the profit or loss is calculated by multiplying the points gained or lost by the amount traded. As one lot equals to 1 unit of the index, then our profit is equivalent to 16 points times 100 lots and times 1 unit. So that gives us $1,600 of profits in this case. Okay, so enough about all these profits and losses calculation. We can look at our next topic on trading orders. So let's start by looking at a market order. A market order is actually the most basic and common type of orders. So this type of order actually executes the trade at the best available price at the time the order is received. So you may want to use the market order to enter a new position or to exit an existing one. Okay, so now we can recap a bit on our bid and ask price. So bid price is actually the best available price to sell at, and ask price is the best available price to buy at. And price is actually always displays the highest bid and the lowest ask price available. Okay, and then we can now look at stop orders. So under this topic, we will talk more about what a sell limit and sell stop is. So for stop orders, we recommend that for mostly newbies in trading, because it will help to limit the risk. But for limit orders wise, it will give better risk reward ratios. So in addition to market orders, we can actually place pending orders. Pending orders are actually orders that will be executed when the price reaches a predetermined level, and they are categorized into limit orders and stop orders. A sell limit order is used to sell higher than the current market price, and a sell stop order is used to sell lower than the current market price. Okay, so as you can see, okay, then next we can look at what a buy limit is. So buy limit is actually used to buy lower than the current market price. So let's say if we bet that prices will drop to the buy limit level here, right? Then chances are we can put our buy limit at that support level, a swing low level, because we're betting that prices may pull back and increase by a larger extent. So that's where we can put our buy limit here at this swing low level, and we can profit from a higher level. So let's say if prices were to increase to this point here, then prices will actually rush from here to here, so we can benefit from this amount. Okay, then we can look at buy stop. As opposed to buy limit, buy stop is actually used to buy higher than the current market price. So we can imagine that to be, let's say this is our pivot in this case, or our entry point, and we are still betting that prices will go up. So let's say prices stop here, then you can see that we actually profit from this gap, but the gap of profit, I mean the extent of profit, would be lower than what we did if we were to put our buy limit at this swing low level. Okay, so buy limit and buy stop would be some of the ways where we can bet on higher profits level. Okay, then we can now look at another concept on orders. We can look at trading stop. So simply put, a trading stop is basically a stop order. It's a kind of stop order that's set based on a predefined number of pips away from the current market price. Okay, so what happens is that the trading stop will automatically trail our stop loss as the market moves in the direction that we want it to move into. So if it moves, if it's bullish and it goes up, then it will actually you kind of like trigger our trading stop to be moving along together with this graph. So let's say if we set our trading stop to be 20 pips, like here, then you can see that as prices move and move and move, our trading stop would actually move along. So the difference will always be 20 pips as our units. Okay, so let's see. If any correction by the predefined number of pips will actually trigger the order and close the position. So what it means is that, let's see, what if prices, instead of going up, it now goes down and actually exceeds beyond this 20 units, 20 pips difference. So once prices crosses this 20 pips of difference, then the stop loss would be triggered and it will close our position to prevent us from further losses. So this is how the trading order works. Okay, then next we can move on to our next session, where I will walk you through what cash accounts, main accounts, and what leverage means in trading. I will also be introducing to you on what margin is and margin cost is. Okay, so let's look at the difference between a cash versus a trade account. In a cash account, the maximum buying power is equivalent to the amount of capital, the amount of money that you invest. In other words, if you have $10,000 of deposits, then you can buy shares, currencies, or instruments up to this amount. So you can't exceed beyond $10,000. Whereas in the case of a margin account, traders can actually take advantage of leverage to trade bigger positions than the value of your deposit. So what it means is that you can trade beyond $10,000, which was your original deposits. So let's say, let's look at leverage, which is a concept that's relevant to what a margin account is. So leverage is basically a loan, right? It's a loan, you borrow money from someone. It's a loan that's provided by the broker to the investor that enables the investor to trade bigger amounts than his initial balance. So the leverage ratio could be, let's say, 2 to 1, 3 to 1, 10 to 1, or even up to 500 to 1. To explain what it means, let's just go back to our example of depositing $10,000 in your trading account. So let's say if you choose to trade with a leverage of 100 to 1, that's a leverage ratio of 100 to 1. What it means is that you can trade beyond your $10,000 of deposits, and that means you can trade up to 1,000 times more than that that $10,000 you had previously. So now you can actually trade $1 million. So in other words, the leverage actually provides the means to an investor to have increased trading capital and giving you the opportunity to maximize your outcome. Okay, so let's look at two scenarios here and illustrate how leverage actually works in a margin account. So in the first scenario here, suppose we made an initial deposit of 10,000 euro dollar, and with the choice of the leverage ratio of 100 to 1, that will give us a trading capital of €1 million. So now if we were to buy $1 million euro dollar at the price of 1.13, and now we sell 1 million euro USD to close the position at 1.14. That means we would have almost doubled our money in this case, because you see that we have profited from 100 pips, because this is actually an increase of 0.01 or equivalent to 100 pips. And 2 times back to our trading capital of $1 million, right? $1 million, and it would give us 10,000. And now we have gained almost 100%. That means like 1 times more than our initial deposit of $10,000. Okay, next we can look at a second scenario. So now we have an initial deposit of 10,000 euro with a leverage ratio of 100 to 1, so it's the same. Again, the trading capital is the same at €1 million, but now we buy Euro USD at 1.13. This time round, let's say if the prices actually goes down instead of going up, and we will have to sell and close our position at 1.128. So the pips lost would be 20 pips. On this position, that would be $2,000 because we are using 20 pips to times our initial trading capital of €1 million. So in this case, we actually lost almost 20% of our investment. Okay, so after we're done with introducing to you on the leverage, we can now look at what margin means. In this case, since a trader is allowed to use more capital than the initial amount he deposited because of leverage, then a collateral in the form of margin would be required by the broker to ensure that all losses are recovered. So in an account balance, let's say if we have $20,000, that's our balance in the account, and we have a leverage choice of 20 to 1, then the required margin for the open position is calculated by using 1 to divide by the leverage level of 20, which will gives us 5%. So if the leverage choice is 100 to 1, then again, the required margin would be 1 divided by 100. That gives us 1%. So simply put, margin is the value of the open position multiplied by the margin percentage. So let's say for a margin of 1% and for position size of $200,000, then the margin would be $2,000. Right, so as you might have already noticed from here, so margin is directly linked to the leverage level of the account. Next, I will walk you through what free margin and margin levels are. For an account with an initial balance of $20,000 and a required margin of 1%, and if we were to take a position of $1 million, and the open price is at 1.13. If we assume that at the price of the opening, the profit is 0, then the account balance is actually 20,000, whereas the required margin is at 10,000. So free margin is basically calculated using the account balance minus the required margin. So that means in this case, that would be $20,000 minus $10,000, and that still gives us $10,000. That means we have $10,000 available to open new positions. In percentage terms, our margin level is the account balance of $20,000 divided by the required margin of $10,000, and that gives us 2 times. So that's actually 200%. So if the price of our investment dropped from 1.13 to 1.12, the loss would be $10,000. And the new account balance is basically calculate, it would be 20,000 initial deposit minus our $10,000 of loss, and that gives us $10,000. So the required margin is actually the same as before, it's still at $10,000. Now the free margin would actually is now actually the new account balance of $10,000 minus the required margin of $10,000 for the new positions, and which that would gives us 0, because that means we have no more free margin to open any new positions. So in percentage terms, your margin level is now the account balance of 10,000 divided by the required margin of 10,000 again, and that also gives us the same, which is 100%. Okay, so now when our margin level reaches 100%, we don't have any free margin to open any new position, right? So this is where we reach the danger zone. One word we've heard quite recently is that we always call margin calls, and that's something that traders don't want to hear. When your margin level drops to 50%, you will enter the margin call territory where you should deposit more money, or alternatively, start closing some of your open positions in order to meet your margin call requirements. And you have to return your margin level back to 100%. So you can think of it in terms of an alarm or a warning call. If your position keeps losing and your margin level drops to only 20%, your account will be stopped out automatically by the broker and positions will be closed to return the margin level to 100%. So this way, both brokers and the investors will be protected, and it actually prevents losing more money than the amount initially deposited into the account under normal market conditions. All right, at this point, we're actually done with our sharing on margin calls, leverage. So do you have any question? Please feel free to put it down in the comment boxes. Meanwhile, let me give you some highlights on what's coming up next. So for tonight so let me go back to our trading website. Okay. So for tonight, we have a brand webinar, an exclusive webinar coming up at 7:30 to 10:30 p.m. SGT. So please tune in if you're free, where you will learn more about how do you combine different technical indicators to identify better levels to take. So to assess this webinar, you can still go back to the XM webinar page, and you can click onto exclusive webinar. And it will lead you to this page, which is our most upcoming one. It's tonight. Please tune in if you're free. And then another to take note of is that we have a promotion. So if you take this promotion here, you can actually get $50 of trading bonus in this case. So please feel free to subscribe to this promotion if you're interested. All right, if there are no other questions, we will just hang around for a few more minutes here. And if you want us to clarify anything for our slides, you can just drop it in the comment boxes. Any questions at this point? Okay, if there are no further questions, we will just hang off the call after about 2 minutes time. All right, I think there are no further questions. So thank you guys. Thank you very much. So please just tune in to our grand webinar today if you're free, and stay updated for our upcoming webinars on xm.com. See you.